Hi everyone and welcome to this recording in financial modeling series. So in this we are going to discuss how to work out expansion projects. So let's consider an example. So Excelsior Pulp and Paper Limited EPP wants to expand its operations. It is considering the purchase of mulching and pressing machine for its new line of paper worth $520,000. So this is the cost of machine that it is considering to purchase. The company estimates that equipment will enable to increase its revenue by $525,000 each year for the next 5 years, which is also the useful life of the equipment. Okay. The variable expenses related to machines are 250,000 per year and the fixed expense associated with the project are 25. The new machine is much bigger in size. EPP tends to install the new machine in an existing facility that the company is leasing out for $20,000 per year. It means the EPP will start losing that leasing revenue $20,000 per year for the next 5 years once the project starts. At the end of the life, the management believes the mulching and pressing can be sold for $20,000. EPP will require 17.5 like $17,500 of net working capital for its project, which will be recovered at the end of the project. The company uses discount rate of 10% and their tax rate is 30%. The depreciation is at 20% straight line. Use the net present value to consider whether the company should accept the project or not. So let's start doing it. So it is for 5 years, so we'll extend this to 5 years. Okay, now sales are $525,000, right? That it generates this much sales, this much increase in revenue. But one thing to note, if you do this, you will lose out on $20,000 that you're getting in rents. So what I'm going to do is I'm going to adjust this sales by 20,000. So revenues do go up by 525, but you lose out on leasing revenue. So the revenue change is only 505. So this is one key point to note. Cost of goods sold, variable cost is 250 per year. Okay. So gross profit we can calculate, sales minus cost of goods sold. So 255, 255, 255, 255. Okay. Then SGA they haven't given. So there is no selling and general administrative expenses. So let's make it 0. Fixed expense, they have $25,000. Fixed expense of $25,000. Okay. Depreciation we have to calculate. So machine is bought at 520. It is sold at 20. Okay. And the CCA is 20%. So it will be 20% into 520 minus 20,000. So 20,000 is the salvage value. So 520 in minus 20,000 into 20%. So the $100,000 will be depreciation each year. Okay. So EBIT we can calculate. So it is gross profit minus SGA minus fixed cost minus depreciation. So this is the net profit you get every year. Income tax is calculated at 30%. So it is not highlighting. So this multiplied by 30% is income tax. So $39,000 is the income tax. So unlevered income is EBIT minus taxes. Unlevered income is EBIT minus taxes. So we just drag it across. Then we never value anything based on income, we value it based on cash flow. So first is you add back CCA. So this is the CCA, so I'll link it up. Okay. So CCA was 100,000. I linked it up and copy pasted. Now capital expenditure. So what have they given? So capital expenditure is 520 and you sell it back at 20. So this is key. 520 will be positive. You're buying the machine and you sell it later on and get $20,000 back. Okay, so this will be negative. Then increase in working capital, have they given that? Yes, 17.5 increase in working capital, which will be recovered at the end. So 17,500 will be increase in working capital and 17,500 will be recovered back. So cash flows we can calculate. Okay, so it will be unlevered income plus CCA minus capital expenditure minus increase in working capital. So 346,500. If you just drag it out, so you spend this much, year 2 revenue, year 3 revenue, year 4 cash flow, year 5 cash flow. So always compute net present value. What is the rate they are giving? 10% rate. Okay, and this much, 10% rate and this much. So NPV is 258,688. It is positive, so we accept the project. Once again, how to calculate NPV? Equal to NPV function. Discount rate given was 10%. Okay, and we selected all the columns. So these all columns were selected. So since NPV is positive, we would accept this proposal. Whenever NPV is positive, we accept it. If NPV is negative, we reject it. So that's it in the financial. Once again, pause this video again and again, solve it carefully and try it out on your own.